Welcome back to the Tech Startup Network podcast. Joining me today is Casey Williams, a partner and chief operating officer at Fenway Summer, a VC firm investing in early stage fintech companies. Casey focuses on companies building infrastructure for the financial system, with a particular conviction for founders raising their first institutional round in complex policy adjacent markets. Casey, welcome to the show.
Thanks, Ashley. It's good to be here.
Yeah, it's great to have you here. I'd love to have you start off by sharing with our listeners more about who you are and what you do.
Sure. Well, I think you really nailed it in the intro. But as you said, my name is Casey Williams. I am a partner with Fenway Summer. We are a Washington, D.C. based venture capital fund exclusively focused on fintech and financial services. I lead our early stage investing, so thinking mostly about companies at the pre-seed and seed stage, with some Series A kind of sprinkled in there, depending. Our kind of unique thesis or approach at Fenway Summer is that we think about financial innovation and financial policy and regulation as kind of key drivers moving the industry and also producing the biggest outcomes. We think that new technologies and new policies are kind of equally important in how industry moves, how culture shifts, and therefore like how truly venture backable outcomes get built. And especially in a highly regulated industry, having that thoughtfulness, even from an early stage, about policy, regulation, even politics in a lot of ways, it has become increasingly critical. And so that's sort of the unique lens that we view the market through. That's also how we try and be helpful to founders. And outside of that, like I said, live here in DC. Our whole team is DC based. I live here with my husband. And we just had our first baby daughter, Charlotte, who was born earlier this year. Hopefully she won't be making any background noise on this podcast. And then we have a dog and we have three cats. So we're, running a little mini zoo here as our part-time job.
I love it. It keeps you busy.
Absolutely. It definitely does that. Yes.
One of the things that I think is so unique and really interesting about you, Casey, is your background and how you originally started your career as a fourth grade teacher before going through a series of different positions before now working for Fenway Summer. And I've actually tried with a lot of VCs, I feel like over the past few months, who have come from completely different industries from venture capital today, which I think is so cool and so awesome to go through that change. And so I'd love to hear how that happened for you, how you decided to make a change and what it was like to actually go through with it.
Yeah, it's funny. I recently spoke at my old university, Elon, in North Carolina, and I spoke to a group of students that were getting a minor in venture capital. And it was funny. The professor asked me to talk, and I was like, "Are you sure?" Because my advice to them would be, if you want to get into VC, like you don't need a minor in venture capital. Like you should go get a minor in philosophy or architecture, I don't know, whatever you're genuinely interested in. I think what is so great about this industry and investing in this asset class is that the more unique your perspective, the better likelihood you have of unique outcomes. And like those unique outcomes might be very bad. Like this all might lead me to be a very poor investor, but there's also a good chance that it might lead me to be a really great investor as well. I think the non-linear path creates those asymmetric outcomes that you're looking for in something as risky as venture capital. And so I've always been quite kind of proud of that in my background and look for it in the founders that we back and people we like to work with. But what that looked like specifically for me, so I was an English major in undergrad, which meant that my family was very stressed about how I was going to provide for myself in life, and I decided to stress them out even more by joining a nonprofit that helps you get your teaching license. To very wealthy areas, high earning areas. But I joined Teach for America. I was part of their 2015 core, placed in Tulsa, Oklahoma, to teach fourth grade math, and it was the best first job that I possibly could have had. I mean, talk about like a position that helps you build real leadership skills, real autonomy, learn about decision making, like learn how to explain things with clarity and conciseness. All of this stuff, you get that hands-on right at the very beginning. And I loved teaching. I was really driven to TFA out of, I think, a desire that lots of undergrad students have of like wanting to change the world, right? Wanting to have a positive impact. And what I saw with my students was, most often the problems that they were facing were not educational, they were financial. And I was really curious about this, and I felt very hamstrung as a teacher that I was not able to solve the actual problems that my kids had. So I started thinking about, well, where could I go to solve some of those problems? I wanted to stay in nonprofits, but I wanted to learn a little bit more about finance, and so I ended up joining Kiva, which is a nonprofit microfinance, microlending company. And I helped them with their US based microlending business. So that was my exposure to, how do small businesses create wealth? How do you think about lending and underwriting? How can finance, unlock access for people? And that was like, I just completely like fell in love with the industry from there. Realized though that I had only seen a very small slice of finance, and so I was like, well, where do you go to learn more about finance? Like you go to a bank, right? You go to banking, and so I ended up moving from Oklahoma to San Francisco to join the team at Wells Fargo. I worked in their innovation group. And that is how I met Raj Date, who's our managing partner here at Fenway Summer. So I would say, a nonlinear path that was a good mix of like continuing to follow these breadcrumbs of how do I make a difference? How do I solve these problems that I'm seeing? What is interesting to me? And a good mix of luck. Like when I first met Raj and he was like, I run a venture capital firm, I was like, cool. And then like Googling on the side, like, what is venture capital? And so, would not have stumbled into this industry if it weren't for conversations with him really unlocking like this, what this means, and wouldn't be here if it weren't for him kind of taking a chance on me and saying, sure, this person who clearly has no idea what I do kind of is, it seems interesting. Like maybe we'll let her work for us for a little bit.
Oh my gosh, what a story. And I always think about the butterfly effect if you ever think about it too. And so for our listeners who aren't sure what that is, it's like basically the idea that if you didn't do one thing in your life, like there's so many things that came after that decision that likely wouldn't have happened. So it makes me wonder, like, what if you didn't take that job at Teach for America and like started seeing that all your students were kind of facing financial problems? Like, would it have led you to VC? I think it's so interesting to think about.
Yeah, absolutely. I feel like of the many paths that my life could have taken, the one that I am currently on is like not one I would have put on my bingo card whatsoever.
Yeah.
Which is super funny. I mentioned at the top, parents very stressed about if I was going to make money, and now now my dad. I grew up in North Carolina, and my dad was like a baseball coach, like very much not in the world of business, does not know what I do. Pretty sure he tells people I'm a banker, and I'm always like, yeah, Dad, that's fine, it's okay. And so, but he's just very happy that I'm no longer making a teacher salary. Although I would argue that teachers should definitely make more than VCs, but maybe that's a conversation for another podcast.
For sure. I'm in agreement with you. And one of the things that I really admire about Fenway Summer is that you guys specialize in fintech specifically. And so, say we have listeners who are tuning into this episode who are fintech founders themselves and they're in the early stage. What are some things that you all look for when looking to invest in startups?
Yeah, so right now, I think that there are two things that I'm really trying to focus on in conversations that I'm having with founders. The first thing, we always talk about product market fit, but I invest earlier than product market fit. So I'm really looking for founder market fit. I really want to understand, like, why are you the right person to be building this business? And what is the unique insight that you are bringing to the business that other people haven't figured out yet? I think the proliferation of technology, AI, like how easy it is to build all of the pieces of a software business, all of the like all of the technology has become so accessible, which I love, but that means that the tech moat has become very, very thin, right?
Mhm.
If anybody could build any business using vibe coding, like then why does your business deserve to exist, right? And so I spend a lot of time trying to really understand how founders are thinking and also sort of like how they're wired, to determine, if this is really the thing that they are kind of going to be committed to, and if it's the thing that we want to be committed to with them. The second thing with that is, especially in financial services, I think that distribution is becoming like sort of the ultimate moat, and is something that is hard for people to replicate, and it's hard for somebody to come in and like copy or take over a defensible distribution strategy. So spending a lot of time thinking about like what does go to market look like, and how does that scale over time from direct sales to like a one-to-many flywheel, which, again, in financial services, I think is really hard. Like these are long sales cycles.
Mhm.
Sometimes, financial institutions don't work the way that we would maybe like for them to, in terms of technology adoption. And so how a founder is able to navigate that, I think is always really interesting. Um, the last thing that I'll say for early stage companies, this is not necessarily something that a founder needs to bring to the table, but something that I'm always thinking about again is that regulatory defensibility. You know, does the business get harder to compete with, as it builds compliance or as it builds with policy in mind? Are there regulatory headwinds or tailwinds that they're going to face? These are all kind of questions that I think about, and no matter what the answers are, I think there can be interesting outcomes. There's sort of this fallacy that like regulation is a necessary evil, for startups, or that it's a tax on innovation. And a lot of times we've actually seen like in the hardest regulatory markets for a founder that like being able to build despite that and being able to build with that in mind create something that again like no one else can come in and take away from you, and so that's always a question that I bring to conversations, and I love it when founders also kind of want to like nerd out and talk about that with me.
Oh, I love that. And that's such a good point too, that like you said, some people might think that regulations might hinder their creativity, but on the opposite end, it creates a space for creativity because you have to be creative and innovative to think about ways to be in compliance and be able to be aligned with those regulations that come up. So I think that's a really unique perspective that you shared.
Yeah, a lot of times those constraints are the opportunity, right? And I think that like understanding how to navigate the things that are on paper, but also like the unspoken piece of how policy gets made, where things are moving directionally, what does it mean for a current administration to be less focused on regulation? What does that mean when there becomes like a more regulatorily focused administration 4 years from now? Like these are all things that, I don't think any founder should have that as sort of like the core piece of what they're spending all of their time thinking about. And that's why having a partner like us on your cap table can ultimately be really helpful, because it is one of those like important and necessary pieces, but it's not going to be like, it's not the piece that I want the founder to be spending all their time on. Like I'm happy to do that for you.
Oh yeah, absolutely. And also really love what you mentioned too about the distribution piece because I feel like that alone throughout probably the past year or so at least has become huge. Like I recently read an article, I think it was in Business Insider, about how founders are now feeling so pressured to really build their personal brand and how they constantly have to be showing up because now like having a great product is one thing, but if no one knows about it, that's a problem. So I think it's really interesting you mentioned that distribution is something that you all really look for and see if that go-to-market strategy is there for the startup.
Something that has been really tough about the current market is that I am starting to believe that even if you have the superior product, you might lose, because that's just not the most important part of the sales process, especially early stage. It might be the individual founder. We certainly have founders in our portfolio where it's sort of like their expertise and experience. It's their charisma, it's their insight that really gets them through the door to whoever it is that they are selling to. But sometimes it's also just understanding the right wedge for your product, right? Like where is the pain point so pervasive? Like who is the person that you should be talking to, especially when you're talking about enterprise sales? Talking to one person in a company is not the same as talking to another. And so which one do you need to be spending your time with, and how do they think about their budgets, their buying cycles, things like that? I think all of that has become increasingly important, and it changes the calculus, right? Like where are you spending time? What are the skills that you need on a founding team? Even for fundraising, like,
Hmm.
where are you putting those dollars? I think that uh, you know, there used to be this idea. I feel like VCs would really frown upon too much money going into marketing or going into business development. And I think that for many businesses, that's starting to shift. And especially as like technology costs just naturally have gone down again with all of these innovations that I mentioned earlier.
Definitely. Yeah. And I mean, you of course probably see this being in the VC world, but there's also been so many instances of VC firms building out like their own distribution channels for their founders and ultimately becoming like a media company themselves, which just I think goes to show the importance that these VC firms like really emphasize on go-to-market strategy, making sure that these startups are getting seen and heard and discovered.
Yeah, yeah, absolutely. Whether it's, yeah, that marketing machine that you have on behalf of your portfolio companies, or in financial services, a lot of times what we see is funds who they raise capital from, from the industry, right? Their
Hmm.
LPs are banks or credit unions or whatever it is, that then their founders can sell into their ecosystem of LPs, which I think is always like a huge benefit to those founders.
Definitely. And one thing that we briefly chatted about that I'd love to dive into further is the fact that you focus on those policy adjacent markets. And so I'd love to hear why that space is interesting to you and also what makes it challenging for founders to navigate.
Yeah, kind of like I mentioned earlier, I think that there is this narrative, or I guess I'll say in financial services, I think there was this narrative. Like I remember when I first got started in venture, and I would talk to people and say, Fenway Summer, we think about policy as much as we think about innovation. And the response that I got was kind of like, oh, like that's cute, and then quickly move on and like talk about something else. And it seemed, I think that people thought it was sort of a nice to have at best and like maybe a waste of time at worst, honestly. And in sort of like the US financial system, I would say like late 2022, early 2023, the bankruptcy at FTX and then the bank crisis with SVB were the two big wake up calls, where across the startup industry, no matter how much you had or hadn't been paying attention to finance, there became this like realization moment of like we are not actually paying enough attention to these systems, and how governance or policy is sort of underpinning the processes behind this like crazy growth that we're seeing. And and I think that to a certain extent we might be in a little bit of a similar cycle with AI right now, where there is this like completely unmitigated growth, that policy has like not kept pace with at all. And that's not to say that I think that we should slow down. That's not to say that I am pessimistic about the like kind of AI race whatsoever. It's a space we're investing in heavily. But it is to say that I do think that at some point there is going to be a little bit of a reckoning there where founders are going to have to reconcile with whatever policymakers do eventually decide, whether that's at the state or the federal level related to AI, and AI broadly, but also specifically how it relates to financial policy. And I think that if companies have been thoughtful about that as they've been building, even if the policy that lands is not what they had in mind, they will be able to withstand that, pivot through that, communicate through that with regulators in a way that founders who have just kind of had blinders on and said, we're just going to take this opportunity and run with it, are going to end up kind of smashing into that brick wall of policy making in a way that I think is going to be painful for them and potentially for their customers. So, all of that I think gets baked into how we think about the space and what we try and keep tabs on for the portfolio companies that we support.
That's a great point. It's like the whole idea of being proactive rather than reactive, so that, like you said, even if they don't know exactly what policy is going to hit or not, they're at least prepared and can pivot quickly compared to other founders or other startups that, like you said, are just kind of have their blinders on or aren't really focused on all these different factors that could come into play here.
Yeah, and I mean, to be fair to founders, like regulatory timelines are super unpredictable. And so like having a founder or having an early team that can really like play that long game and build up that credibility is important because like we don't know. In finance, I think crypto is a great example here where that vertical in the industry has been building and building and building for decades. And we just now, it was 2025 when we got like our first direct, crypto legislation on the books in the US with the Genius Act. And so and like we saw that there were companies who had been really mindful of how that conversation was evolving in Washington and companies that were not, right? And
Hmm.
so it just creates kind of these interesting dynamics. And we're sort of comfortable with this idea that like in startup land, founders, investors, whoever it is, will fall on either side of this argument. Not everyone has to agree with us that this is an important thing to think about at an early stage, but for the founders that do think that or do want that resource, like it makes it just a lot easier for us to find the people that we really want to work with and support.
100%. And on that topic of finding the founders that you like to work with, you demonstrate having success in backing what you call non-consensus founders. And so I'd love to hear what that term means to you and if you could share some examples.
Sure. I think there's sort of a cliche or a blanket explanation of non-consensus that you could say, we back founders that other people don't, whether that's like statistically money goes to like white men more than it goes to anyone else. And so if you're backing anyone else, you can say, oh, I'm backing non-consensus. And I think that's fine. I think that's one sort of layer of the definition. But I would say the way that we think about it is really like um, in venture, there's become a stereotype, whether it is your like educational pedigree, your career pedigree. If you acquire a certain number of logos on your resume, then you're guaranteed to get a certain number of venture checks when you finally decide to go and start your own business. And to me, like non-consensus is instead of looking for those check boxes that have become the standard in venture, looking for the description of the person that makes sense for the market that they're building in, right?
Mhm.
That might be their background. Like there are some areas of finance where it is really important that you have the experience and the expertise to do what you say you're going to do. Like credit is a great example of this. If you want to build a lending business, it is important to me that you have managed a book of loans, right? Like that you
Mhm.
that you understand how debt works. But then there are other areas of finance where the expertise or the experience that you have and that you're bringing to the company are completely separate from the finance verticals that are kind of underpinning it. And like we could think about this across lots of things. There's so many things that finance touches in our lives, but the actual finance piece is not the important piece. So like student loans is a great example, right? Like anyone who went to college probably at some point had to interact with the student loan system. But getting a loan was not the point. Like going to college was the point. And so we've backed a number of founders that are building companies at different points of that kind of space um, with the perspective of like, how do we either unlock access for people to attend college if they were maybe like the first person in their family to attend college, for example? Or how do we create more creative systems to reduce the burden of student loans on people after they've graduated from college? And so, we've invested in companies that create student loan repayments as an employer benefit, similar to a 401k match, right? So those are like some examples that kind of immediately come to mind, where your background kind of becomes the credibility check, not just like what you're sort of able to list on a resume. I think that those like lived experiences often beat out whatever like pedigree you can list.
Yeah, totally. Because it's like, who knows the problem space best besides the person who's gone through it and who has experienced it themselves. So I think that's a really good point. And I'm curious too if you, because we've talked about it a few times, like just the rise of technology and how it makes things so accessible now to build, if you find that you're investing in solo founders more often than you were previously. That's a conversation I've had with a lot of investors lately is how like having a co-founder was like almost always a non-negotiable. But now because of technology, there's a huge rise in solo founders because it gives non-technical founders the ability to be technical because of everything that's available now.
That's really interesting. Being a solo founder has never been um, a red flag for us. It's never been a non-starter for us. Although I can't say that I think that we've tracked data on how many like solo versus co-founders we've invested in. I actually think I almost would say like off the cuff, I feel like I've seen more of the opposite where
Mhm.
it is a small founding team, two or three co-founders, and they stay just two or three co-founders for significantly longer. Usually in a pre-seed or a seed raise, part of what I'm evaluating is like looking at a financial model or a budget and trying to see how much someone thinks they're going to need to pay their first engineering hires or their first sales hires, and if I think that's like reasonable or not. And now in most pre-seed raises, I'm not seeing any money go towards hiring. It's not until sort of like seed and beyond that you're adding to the team, because you're able to just get so much further towards not just an MVP, but like a viable first product, something that works with your design partners with just one technical co-founder, or even, yeah, like a handful of founders that are able to use the tech tools available to them to build something. So I would say like the team dynamic is definitely changing, and
Mhm.
I could totally see the argument of how it's changing on both ends, enabling more people to sort of be able to go out and build what they want, even if they don't come from a technical background, or enabling a small team to sort of stay a very small, lean, and nimble team for much longer.
Absolutely. And one question I have for you is that prior to becoming partner, you started out as COO, which you still hold that title. And so, because you have that operations experience working for Fenway Summer, I'd love to hear how that has shaped how you work with founders as well.
Yeah, absolutely. So I spent my first 3 years at Fenway exclusively on the operating side. It's a little bit funny to like, parse it out in that way because we're such a small team,
Mhm.
that, anybody who works at Fenway Summer, it's sort of like an all hands on deck. But what I was mainly responsible for, right, was all the behind the scenes, sort of business day to day stuff for the first couple of years. And then I started kind of leaning into investor relations and working with our LPs. And then I started leaning into supporting our existing portfolio. And then I went into kind of the start of like making net new deals and starting to source deal flow. Which is a super weird way to learn venture. I basically like started at the end and then worked my way back to the beginning, right? Most people, most VCs, don't really think about like the process of an audit or
Mhm.
like working with their tax and accounting teams, until they are a GP raising their own fund, right? And they're having to put together their own fund model. That's actually like where I started, right? So when I think about what that means for the founders that I worked with, I mean, one thing is just, the black and white ops stuff, like that is my bread and butter. And so thinking about an early team that's got a CEO and a COO, but they don't quite know how they're thinking about what those roles mean and all the pieces and parts. I like to think I can be helpful in being strategic about what fits in the ops bucket and then actually how you break down like what that job literally is.
Mhm.
Because I have done it for so many years. I think the other thing is, like that operator sort of ethos, I think just never went away for me in a way that it might have if I had started my venture career as an associate or an analyst and worked my way up the sort of traditional investor path. The role of an investor is like so amorphous. It's very in your head. You spend a lot of time, talking to people, doing research, like writing memos, doing analysis. There's not a ton of like black and white, like I just have to get this thing done. I have to meet this deadline, hit this metric, tasks in being an early stage investor. But there are a ton of those on the operations side. And so by continuing to be a part of that piece of the world, I think it also has been easier for me to like understand the very like tangible pieces and parts of things that have to get done for a startup to build. And I avoid being too in the meta, like heady land of investor world where I just get to like ask questions and give advice and like posit my thoughts. As much as I love to do that, like I'm also more than happy to like sit down and dig into customer retention numbers and build out cohorts and like actually help you organize your accounting metrics and principles so that you've got something that makes sense and not like just a random, balance sheet and P&L that you don't quite understand. All of those actual things that you sort of have to do that physically build a company.
Oh, yeah. So it's like by you being able to be that incredible support system for the founders and startups that you work with, it's like they're able to really make sure that all of their ducks in a row, all of their ducks are in a row, which of course contributes to their success.
Yeah, I mean, I certainly hope so. I love getting to work on all of the different companies that we invest in. And so I think like founders that I work with sometimes are like, are you sure you want to like do this random thing for us? And I'm like, I really enjoy it. I think that one of the great parts of venture is that you build this portfolio career without even having to try.
Mhm.
And I'm now convinced that I'm like totally ruined for regular sort of like corporate work where you are in like one role doing one thing for forever. Like I can only do one role of one thing for like a day, and then I have to switch and find something else. And so I really enjoy that piece of the work, and I think hopefully the founders in our portfolio feel like both strategically and operationally they have kind of a second set of hands when they've got Fenway Summer on their cap table.
Yeah, I love that. And what would you say is like something that either the VC world or tech community in general still gets wrong about fintech? If there's like a misconception or a myth that's constantly floated around that you feel people are getting wrong right now.
Mm. Well, I mentioned earlier there was, late 22, early 23, this big pullback from fintech. I mean, kind of broadly across venture, but I think fintech was hit really hard, and there was a little bit of. I think the sentiment at the time was like, this is not really like fintech and venture don't mix, right? These
Hmm.
two asset classes don't go together. Because it's a long sales cycle, especially if you're selling into a financial institution or if you're working with a financial institution. A lot of these fintechs need bank partners, or they need access to payment rails, whatever it is. Like these things don't happen on kind of high tech, high growth timelines often. And then the ultimate outcomes for fintechs, if you think about the way that tech startups are valued compared to the way that banks are valued in the public markets, like there was sort of this idea of fintechs might just be growing too slowly and not growing big enough to be like an interesting place to invest. And there was kind of this like pullback and risk off sort of approach. Um, which like I'm empathetic to, which I
Hmm.
understand, right? Like navigating those long sales cycles, figuring out the complexity of these partnerships and relationships is a big part of what we talk to our founders about. I think that the thing that investors missed when they did that was how pervasive the financial industry is. A16Z, I think, is the fund that coined the phrase that every company is becoming a fintech company. The way that we think about it is finance is the underpinning of everything. And so you're only so many degrees separated from something that's touching the financial system if you are building a business. And so that like you sort of then can't separate like the venture outcomes and the tech outcomes from the financial outcomes.
Hmm.
So I think that's kind of one piece, and we're starting to see, I think, some of the investors, advisors, operators that left the industry like slowly starting to come back, but with some lessons learned from they took some of those like scars from that time period. And so I think that's something that people are starting to shift or maybe like refine their perspectives on.
Oh, I love that. And as we get into the second half of 2026, what's coming up for Fenway Summer that you're able to talk about? If there's anything exciting that your firm is working on or anything new that you've been backing, would love to hear what's in development lately.
Yeah, well, the second half of this year, I'm just excited to be like back in full swing of things after maternity leave. It's just been very cool to get reconnected, and it's kind of, it's kind of wild how much things have changed and how much I feel like I missed from those couple of months out, but I feel like I'm very quickly getting up to speed with where we are now and where we're going with, all things kind of AI tech innovation startups. For Fenway Summer in particular, the most exciting thing for us in the second half of this year will be raising our next fund. So we're targeting a $50 million fund that we're going to be going out and raising the second half of this year. Still, continuing to do all of the same things that we've been talking about for this whole conversation, focusing on early stage fintech, focusing on how regulation and policy impact innovation. I think now more than ever, this thesis makes sense.
Mhm.
And I think there are some really obvious areas where financial services and AI and compliance are all kind of enmeshing together, and where founders need that extra expertise and support to help them navigate that, but also where like there are going to be real outsized opportunities. So I'm excited to get to fundraising, like finding those people that agree with us that this thesis is interesting and exciting, and finding those next founders that we can support. We'll be actively deploying capital through the raise. So we're still doing deals, still excited to meet founders, meeting co-investors. I know there are a lot of other VCs that listen to the podcast as well. So if you're out there and you invest in early stage fintech and want to chat about any of this, would also love to do that.
Amazing. Oh, that's so exciting to think about your next fund and how you're actively deploying throughout this time too. So it'll be really amazing to see how that progresses throughout this year.
Yeah, yeah, I'm very excited. I mean, listen, like, I don't want to come across as naive. Like, I know that the fundraising environment is very difficult right now, but I really believe in the fund that we're building and the thesis that we have. I don't necessarily think that's going to make it easier to raise. It just means that at least it's like a conversation that I enjoy having. So, we'll see how that goes.
Totally. Casey, this has been such a fun episode, and I've so enjoyed having you on the show to share everything that you've been doing behind the scenes at Fenway Summer. And I'd love to have you share with our listeners. They can find you online in case they'd like to connect.
Yeah, I am on LinkedIn, Casey Williams. You're more than welcome to connect or message me there. And basically everything that I do lives out of my inbox. And so you're also welcome to just email me directly. My email address is casey.williams@fenwaysummer.com.
Amazing. And I'll include both those places in the show notes for listeners to easily find you from there. Thank you so much again for coming on today's episode.
Awesome. Thanks, Ashley.